Hello investors, I'm Stuart Cruz and welcome to Market Mondays. It has been a crazy year to say the least, ups and downs in both the markets and for most of the people I've spoken to personally. It's been a year of two stories, whether it's been being upset because you're locked down or getting closer in touch to family and friends and back to basics. So it's been that similar story for the stock market. And let's just look at how the markets have gone with about 3 weeks left in 2020. So right now I have up on the chart from our friends at White Charts, the S&P 500 just for the month of November. And we had a monstrous month, up 9.4%. And you might want to think that you're going to get a pullback when you had a big month like that. The numbers would suggest, and momentum generally works, that when you see an upward trend, you're going to continue with that upward trend. You can't make new highs without going through past highs. So the market may feel expensive, but you never reach higher highs without breaking your last higher high, right? So here we are in November, up 9.4% for the S&P 500, and year to date, there's that 14.4%, humongous drop down during that lockdown in March. And then nothing but rallies along the way, taking us back up to higher highs, and we opened at new highs today. But let's look at the rest of the sectors and see how that worked out. So here are the international markets in orange, only up 6.2%. But if I look in a shorter time frame of 1 month, the S&P, while still doing amazing over the last 30 days, is up 5%. This has almost been doubled in the international market. So there could be a changing of the guards. If you look, the momentum was a little bit lower. The relative strength is a little bit lower for international, but maybe there's going to be a turnover. And U.S. markets have been the only place to be for quite some time. This could be another changing of the guards. Let's look at bond market here. Bond market has been pretty flat. So interest rates have been in a steady decline. So bond markets have performed reasonably okay throughout this year, but you're talking about interest rates starting at 0 and then moving up. So if I add the 10-year note, we had a big decline in the 10-year note, and more recently we've started to move up from off of our base low of 52 basis points more towards, well, let's take a look at where we're at right now on the 10-year Treasury note, just under 1%. So we've had a nice rally there. So that's why our bonds are selling off. So our bonds are very flat for the last month or so. And you can anticipate with interest rates moving up, as we're seeing in the 10-year Treasury, that bonds will probably underperform. Like, there's not a whole lot of room for the interest rates to go except for up. And when that happens, bonds drop. So let's clean up this chart a little bit. I'm going to take off 10-year Treasury and bonds and even the international market. And we're going to look at the REIT market. The REIT market month to date is up as well, just alongside the U.S. market, and year to date it got crushed. So again, a return back to a new story of perhaps real estate is showing some strength, and we have kind of the opposite story of gold, where gold kind of held strong and then over the last kind of month has underperformed. So you're reducing that fear-based trade. You're going back to business as usual. I think you see the light at the end of the tunnel with the vaccination. Basically, the markets will discount 6 to 9 months. And by that time, there should be widespread distribution of the coronavirus vaccination. So the markets are easily looking through that onto 2021, 2022 earnings. Couple that with the Brent crude oil spot pricing, you can see oil is up considerably now. That's the line in green. So oil is down 30% year to date. But again, if we look at the last 1 month, oil is up 23%. So again, oil tends to be an indicator of economic activity. As economic activity is going to be picking up, then oil prices should be picking up as well. So you're seeing that kind of change in the guard. And last but not least, let's take off some of these things and let's look at Bitcoin pricing, because that's been in the news. So here's the S&P 500, and here's Bitcoin up 30%, and year to date, Bitcoin is up a whopping 166. But let's go back 3 years. You've seen this dive when Bitcoin has peaked before, dive down, and we're only up in a 3-year window up 14%, where the S&P is up 40%. So you've seen quite a big movement over time with Bitcoin. So at a 5-year chart, you hit a big rally, a sell-off, rally, sell off. You broke through these higher highs. So that's actually a good technical signal for Bitcoin, as we talked about technicals in the past. And increasingly more and more asset managers are putting Bitcoin as part of their portfolio. But that's how all these asset classes have done, let's say in a year to date. I'm going to put them all on the chart. Bitcoin, 10-year, gold. So here's all the charts. You have Bitcoin up here, the winner. That's kind of distorting the chart. And then you have gold shares up year to date. You have the S&P. Bonds did pretty well. International equities. And then some of the losers so far have been real estate, oil, and the 10-year treasury. But all of those are turning around. So this is Stuart Cruz with your Market Mondays, trying to wrap up the year end of 2020 and trying to help you to live your life with the odds in your favor.